Good morning. In the standard economic model, markets should perform rationally. The assumptions are that buyers and sellers act rationally. In those cases where the market gets out of sync, the economic theory is they will quickly get back to equality. All of us in this room know that that is not the case in the aircraft market. Buyers and sellers don't act rationally. The results are a marketplace with fluctuations in price that are anything but rational. The field of behavioral economics got its start in the late 60s and has gained ground ever since. It helps model real economic behavior versus theoretical rational economic behavior. It is so important that Dr. Richard Thaler won a Nobel Prize in economics for his work in this field. These economists teamed up with the fields of psychology to come up with the new models that better explain the real workings of the marketplace. They could have saved a lot of time and effort if they just started with the aircraft marketplace. The following is an example from misbehaving by Dr. Richard Thaler that we can all relate to. Suppose you bought a case of good Bordeaux in the futures market for $20 a bottle. The wine now sells at auction for about $75. You have decided to drink a bottle. Which of the following captures your feeling of the cost to you for drinking the bottle? Now take your devices and vote for the one that matches your thoughts. A, 0, I already paid for it. B, $20, what I paid for it. $20 plus interest. D, $75, what I could get if I sold the bottle. And E, $55, I get to drink a bottle that is worth $75 that I only paid $20 for, so I save money by drinking the bottle. What is the correct answer according to economic theory? According to economic theory, the answer is $75, since the opportunity cost of drinking the wine is what it's selling for. A true econ, rational buyer would choose this answer, and most economic theory is based on this. The above question and survey was given to over 170 professional economists. Here are the results. 0, I already paid for it. 30% selected that answer. B, $20, what I paid for it, 10%, or 18%. $20 plus interest, 7%. $75, what I could get if I sold the bottle, that was 20%. And E, 25%. Even most of the professional economists did not act according to economic theory. In the appraisal world, by definition, the market value of the real property is current market value is the price at which the property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or sell, and both having reasonable knowledge of relevant facts. The components of this concept are price at which property would change hands between a willing buyer and a willing seller, neither party under compulsion to buy or sell, both parties having reasonable knowledge of all relevant facts as the valuation date. The sale is made to the ultimate consumer in the appropriate market level. Market value is similar to current market value, except that the provision for lack of compulsion to buy and sell is removed, and the assumption is a sale within a specified time frame is added. The primary value assumptions are fraught with rationality issues. The reality, as we all know, is most often they're not equally knowledgeable buyers and sellers. They also have hidden agendas that sometimes even the buyer's agent or selling agent are not fully aware of during the sale. In my opinion, what further complicates this is determining what values really add value to each buyer and seller. An example, does Wi-Fi go-go add value? Well, it certainly does if you're a US buyer. But if you're in an international market, it's only worth the parts. So what is the current appraisal valuation for an aircraft that has a piece of equipment that is not of any value to the buyer? Or what is the value expectation for the seller? How do you account for transaction cost? Transaction cost should not be a part of the valuation. However, in the real world of the marketplace, they're a very important factor. What is the cost of getting an aircraft from China or India to the US? Sales comparisons can become quite misleading without understanding some of these factors. When you look at transactions, how do you determine whether each party is knowledgeable? Do you know that the seller has a use for the capital and needs it off their books to use the capital for something else? That might lead to a compulsion to sell. Or a buyer who has a capital approved for the calendar year that will go away or have to go through the approval process if not utilized in the year it was approved. Compulsion to buy? Taken to an extreme, 2 new interiors, one done in blues and grays, one done in beiges and tans. On paper, both are equal. However, to the buyer, the emotional component of meeting the taste of the buyer might make one aircraft value plus or minus the price of a whole interior. The results and the prices in the marketplace are not a rational representation of the market. The property that has higher volumes and more of a commodity lessens these impacts. Money markets are a good example. A dollar is a dollar and does not have an emotional component to the transaction. It is a commodity. It trades in large volumes. There are many items that trade in high volumes, and while they might have some individual emotional component, like a house in a particular neighborhood, the volume of the transactions minimizes the effects of outliers. The airplane market does not have many of the assumptions that traditional economic theory is based on, and the results are valuations that can be widely divergent. The volumes are very low, and given that some aircraft models might have 20 or fewer trades per year, or even less than that within close model approximation, the results can be very subjective. The back-to-back market exists in large part to middlemen taking advantage of these market inefficiencies. If the market was truly efficient, as economic theory suggests, there would not be an opportunity for someone to make a market by doing a back-to-back. In my opinion, this is one reason that back-to-backs hurt the market. They are adding distortions to a market that already has many distortions. A stocking inventory dealer is a different consideration. They actually buy the asset and have a financial risk associated with the purchase. They represent the wholesale value. The spread is the risk-reward for doing the transaction. This is very different than the typical back-to-back where there is little or no risk, and the spread can be large by taking advantage of the lack of knowledge of the market. Some would argue that the middleman is just using a form of arbitrage and should be rewarded for his knowledge in the market. The buyer and seller get a price they were both satisfied to receive, no harm, no foul. If the transaction has full transparency, then both parties should not have an issue with the transaction cost. The problem becomes when the middleman tells 2 stories and convinces one party that the maximum price in the market is this, and the other party that the higher price they're paying is getting the price for a good deal. If that is within normal brokerage fees, both sides will more than likely, if they find out, not have much of an issue. However, when the fees for a little transaction risk far exceed the norms, then the market becomes distorted. In the above example, what is the real market price? One aircraft results in 2 different fair market values. In theory, this cannot happen. Were both parties knowledgeable? What happens when someone without a brokerage agreement finds an aircraft and the seller advises they want X for the aircraft? He wants to make a large fee for finding the seller a buyer, and then tells the market that he has an aircraft that can be bought for Y, and Y is significantly higher than X. The market now sees a high asking price on the aircraft. No offers are forthcoming. The seller could have perhaps sold the aircraft in much less time and for a good price and very near his expectation, but due to an aggressive middleman wanting to make an abnormally high fee, the aircraft sits on the marketplace. Is this market really slow, or has transaction costs, which are not part of the valuation process by definition, obscured the real value? Irrationality exists in all markets. It is more predominant in ones with low volumes and lots of valuation variables. Prices are not public knowledge, and the ones that do make it into the knowledge base might be widely divergent based on the unknowns in the transaction. It is important that buyers and sellers arm themselves with reputable brokers. Brokers who mislead buyers and sellers with pricing variations to accommodate a larger than normal transaction fee do not build trust in our industry. In a small volume, small world, word gets out, and it's only a matter of time before both the buyer and the seller have a very good idea of the true price. However, even in this example, buyer and seller may not be able to fully understand all the variables that resulted in the outcome. The bottom line is that aircraft market is a prime example of human behavior rather than pure economic theory affecting market values. Non-rational actions impact prices. Once you accept the transactional or irrational behaviors as the normal behavior, you will better understand the variances in the market. Using professionals to help read through this irrational component can help make sense of the values and place them in proper context. The more the marketplace is represented by ethical and knowledgeable buyers and sellers, the more accurate the valuations will be. Data-driven valuations from reputable appraisers are a good starting place. However, it takes more than data to fully understand the actual valuations, and that is where interpretation expertise comes into play. Thank you.
So, Mike, what's the solution? How do you make the business jet market more efficient?
Well, like I mentioned, and we talked about a little bit yesterday, back-to-backs add a further distortion. There's some of the distortions in the marketplace are going to be there. That's just the nature of human behavior, so that you can't really get out of why people pay too much for a particular product with no real reason. But if you can get the transaction cost out of the equation and get people who are making abnormally high fees and telling the market two different stories, it will go a long way to stopping that activity, in my opinion.
Any more questions or comments? If not, oh.
Well, no, that's one that is a question that I was cautioned when I worked for Hawker Beechcraft, the restraint of trade. Probably a broker should never say that publicly, what he thinks a normal transaction fee is. Sorry.
Okay, any more questions? Oh.
Should it be a percentage, or should it be a fixed price for the work?
You know, I don't know if it could be a percentage or it could be a flat fee. I think to go back to the other question, what is normal, if you took 10 brokerage houses and came up with a fee for a large cabin airplane and averaged it out, that would be considered normal in the marketplace. If you have an outlier that is way out of that, I would say that's abnormal for a fee.
Okay. Oh, sorry, Dave.
How do you feel the technology that exists, some of the data in, data out programs that a lot of people in the industry subscribe to? How do you think that plays into the rationality of the market?
I think it helps a lot, but what you find is the data has so many variables behind the data, or the data points, that it's sometimes very hard and it can be very misleading. So, for example, you don't know if the particular price was, an inspection was included, say like on a Falcon, a C-check was included in the price of the airplane. That can alter the valuation by quite a bit. So I think it's very helpful because we see a lot more numbers and a lot more data points, but you still have to go back, and that's where the interpretation comes in. You have to go back and look and say, what drove that valuation?
Great. Thanks very much, Mike. Thank you.